So you might be looking at your tax return this year and thinking to yourself, gosh, I owe a lot in taxes. What can I do about that? Well, in today's episode, we're going to talk about one particular kind of tax that we see all the time, especially in the investment world, and a few things that you can do to perhaps mitigate that tax bill. Hi, I'm John Norberg, and welcome to the Financial Prof Series. So, tax returns often come with a million documents in them, but one of the ones that I work with a lot, especially as it relates to your investments, is the 1099, which typically details your capital gains tax. So capital gains tax is what we're going to spend a little bit of our time today talking about. What is it? Well, essentially, you pay capital gains tax when you have an investment which you bought at one price, but then later sell at a higher price. And the way it works is if you sell that investment typically within a year, then it's taxed as ordinary income, which for most people is anywhere between 0% and as much as 37% plus state taxes. However, if you wait at least a year from when you bought that asset to when you sold it, if you sell it longer than a year after you originally bought it, you would pay the capital gains tax long term, or the LTCG, long-term capital gains. Now, that has a 15% bracket, a 20% bracket, and a 0% bracket. If you're, like most people, you're probably going to land in the 15 to 20% bracket, but there's one surtax you need to be aware of. The net investment income tax, or NIT tax, came about as a result of the Affordable Care Act some years ago, and that's an additional 3.8% on top of that top 20% bracket that you'd pay. So you could end up paying as much as 23.8% in ultimate tax as a result of your capital gains, perhaps. So, what do we do about this? I mean, at that point, we're talking about practically a quarter of what we made on whatever investment we're selling. Well, there are a few things, and I'm just going to point out three. This is not an exhaustive list by any means, but these are three of the more popular ones that I see in terms of being able to mitigate a capital gains tax. Number one, you can do what's called a 1031 exchange. So maybe you've heard of this term. It's very popular with my realtor clients. Basically, it's a like-kind exchange where, let's say you have a house over there that's roughly the same as the one that I own over here, but I like your house and you like my house, and let's say they're both investment properties. You can basically exchange your house for mine, and there's no capital gains pay because it's deferred through the 1031 exchange. This can be a little tricky to make sure you do it right, so especially if it's your first time, highly recommend consulting your professional team, including your tax advisor and your financial advisor. Get them involved and tell them what you're thinking. That way you go through it the right way and not the wrong way, where you get hit with an unexpected tax on the back end that you didn't think you were going to have to pay. So again, that's the 1031 or like-kind exchange. Number two, another option would be to sell an investment with a loss at the same time as you sell your investment with a gain. A quick example of this would be, let's say you've got a business that you're selling and you realize you're going to come up with a $1 million gain on this business. That's great, but that means you're going to have to pay capital gains taxes on $1 million. And again, we're talking about probably close to $250,000 at that point if you're in the top end of the bracket. So what do? Well, you look at your entire financial picture and find out, are there any investments either within that business that could possibly be split out, or on my investment portfolio elsewhere that I could sell that are currently showing a loss. So if you were able to, say, put together a $500,000 worth of losses throughout your entire financial picture and liquidate or recognize those losses at the same time as you realize your $1 million gain, you have now offset half of that gain. In other words, you're avoiding half of that capital gain, which would be taxed, and essentially half of the tax bill from that would fall off in that scenario. Okay, so that's option number two. Sell an investment at a loss at the same time as you sell the investment at a gain, or within the same calendar year at any rate. Option number three, charitable donations. So, especially for my clients, maybe with a religious background, this is a very popular option, although you certainly don't need to be religious to give to charity. This is something that basically, let's say you have an entire portfolio of assets and you're selling a good chunk of them for whatever reason, but most of them show gains. That's great, right? So what do we do in this case? Well, instead of, say, giving from our checkbook to charity for that year, we can instead give our investments to charity, either through something like a donor-advised fund or perhaps a straight-up appreciated asset donation, and whatever we give to charity is no longer considered taxable. So By doing that, we can give our most appreciated assets out of that portfolio to charity, which if we would have already given a certain amount to charity anyway, it's just using our assets in the best and most strategic way possible. And essentially, because those assets are now in the charity's hands and we've donated them directly, when we sell, obviously we don't have to recognize that. This is a very popular strategy, especially if, again, you're going through your portfolio and you realize, hey, assets X, Y, and Z not only are very well appreciated, but can be donated to charity or to a donor-advised fund, which is a way of front-loading charitable donations. And your tax bill will thank you too. So if you're wondering if any of these strategies might be right for your situation, or you'd like to talk to somebody about what might be best as you're thinking about liquidating something with a large capital gain, we'd love to hear from you and see if our services might be a good fit. Drop us a message or give us a call here, and in the meantime, I'll see you out there.